Hey guys, how's it going? I'm Lewis Harding Investor and welcome back to my channel, and in today's video I'm going to be going through ITV stock. I'm going to be using fundamental analysis to see if the company is worth buying or not. I'll be then using a DCF valuation to determine the fair value of their stock. Let's get straight into it. So, who are ITV? So ITV plc is a British media company and they are best known for owning the ITV network, so in the UK also known as Channel 3, so they are the oldest and largest commercial television network in the UK. ITV plc is listed on the London Stock Exchange and it is a constituent of the FTSE 100 index. Right, so let's have a look at the sales for ITV, and it is split between two sections, and it is broadcast and ITV studios, with broadcast making up 68% in 2020 and 32% was ITV studios. Sales per region is predominantly UK business, so 71% comes from the UK and 29% comes from other countries. So now we will go into the income statement, and all of the numbers are in Great British Pounds and the data is from Morningstar. So let's start off with the turnover. So yeah, from 2016 to 2020 it's actually down. Yeah, it was rising up until 2019, but then clearly the pandemic has had a bit of an impact on the business. You'd like to see in 2021 that this rebounds. And then having a quick look at the net income. Whereabouts is the net income? Net profit. Yeah, so it's down, pandemic reasons, you'd just assume. But yeah, it's good that over the past 4 years, from 2016 to 2019, the profit has been rising, but 2020, the blip year, it has decreased. So, like I say, in 2021 going forward, you want to see this number recovering and, going up. Now onto the balance sheet, and yes, so first figure I look at is the non-current debt or long-term debt for American companies. Yeah, so 2016 to 2020 it is actually down, which is good news, of course. Not by much, but down nevertheless. You want this to be going down over time as well. And then having a look at the equity section, let's have a look at shareholders' funds, or otherwise known as retained profit. And yes, this has increased over that time. So yeah, I think it's showing that the business is making consistent profits, and it's showing this on the equity section, which is definitely a good sign. So yeah, it gets a tick on this part. Now onto the cash flow statement, and the only figure I can really have a look at here is the operating cash flow, so part of the free cash flow figure. Yeah, so from 2016 to 2020, it's down, but as you can see from 2017, 18 and 19, it's been down as well, which isn't a good sign. You want to know why this is the case, because you want this figure going up over time. Now let's have a look at the key financial ratios, and we will start with the profit margin. So relatively stable over time, which is a very good sign. Pandemic 2020 year, it's down. That is consistent with the other numbers, so it does make sense, but it's a good sign that we can keep consistent profits. And margins above 10% is very solid as well. Return on equity, very good as well, no complaints there. Very high figures. One of the red flags about this business for me is the gross gearing. As you can see, it is above 100%, which for me is a bit too high. Dividend cover's there, thankfully. Plenty of interest cover. The quick ratio and current ratio are above 1, so that's a solid sign. Yeah, so not too bad. Maybe a little bit too much debt, but on the whole, it's not looking like a terrible business, really. Right, so let's have a look at the genuine impact stats, and we will start with the quality section. So it gets a medium score on this part. So high profitability and financial strength is showing weak, and then capital allocation sound. So a bit mixed there. The financial strength is likely to do with the gearing, like we saw before, and the profitability, like we saw before, consistent. Value section, so it's looking cheap on an income statement basis and a cash flow basis. Balance sheet is medium, not too bad. But then we have a look at the forward PE for this business, and it's showing 7. So yeah, that's very cheap. It's saying market average long term is 16. Decent, really, really decent. And then we'll have a look at the growth metrics in the bottom left hand corner. I always like to put these in because growth is a very important part in all types of investing. Revenue growth is relatively low, and everything else is medium or high. So revenue growth being low is something you really need to take into account when doing your valuations of the business, because growth is very, very important. Right, so now to my analysis checklist for ITV PLC, and the market cap when it did all the data was £5 billion, and the market price was £1.24. Yeah, it shows in pence for UK companies, of course, if you're familiar with them. So the PE ratio is showing 14 with an earnings yield of 7%. And then onto the analysis. So when I did the analysis, I couldn't distinguish gross profit and net profit. So from the data I got, I just used the same one. So net profit margin above 10%. You can maybe ignore the above figure. Maybe they don't have gross profit. Maybe they don't have real cost of sales in their accounts. I didn't have a really good look in the accounts. I just took the data from Morningstar. Net profit margin, decent. Very, very solid, to be fair. No complaints. Return on equity, very, very solid as well. But like I said before, the debt situation is maybe a little bit too much for me to be comfortable. 100% debt compared to the equity, so a lot of gearing in the business. Not a good sign if things do go wrong, of course, and that's one reason I don't like a lot of debt. Luckily though, the current ratio is 1.4, so plenty of current assets to cover their current liabilities. Then on to proven ability to grow. So revenue growth is down over the 5 years, and net income is as well. Pandemic, it just screams of 2020 pandemic numbers being bad. Hopefully we can just recover this going forward up to pre-pandemic levels. Shareholder equity and free cash flow growth has been up, so great sign, of course, no complaints. Great capital allocation. Unfortunately, they have issued a bit of debt. Then dividend growth. Yes, we have been paying the dividends. A classic case of British company likes to increase the dividends to keep investors interested. Shares have increased, and acquisitions wise, I can't think of any company ITV have acquired, so I can't really give them a tick for that. What attracted me to this company was buy at a fair price. It's looking cheap on earnings and a free cash flow basis. For a valuation of I give it a valuation of £1.82 for a 10% return, and let's go over to the DCF valuation to see how we got to that figure. Now let's have a look at the DCF valuation for ITV, and my free cash flow estimates have come from marketscreener.com. The link is in the bio for that. You can have a look at the estimates for yourself. For a rate of 10%, required rate of return of 10%, it's spitting out a share price of £1.82, and from the current share price, it's quite a big difference. So if you believe the numbers here, ITV might be a screaming buy right now. I have my reservations, just a few red flags, but on an earnings and cash flow basis, it's looking cheap. So for the fellow value investor out there who believes ITV is going to be here for the long run, it might be a good addition to your portfolio. Who knows? So what are my thoughts on ITV? So I think from my analysis, I think it's a fairly decent business. So income statement wise, they're making consistent profits, decent margins as well, above 15%, on a consistent basis as well, which is something I love to see. Consistency is key. Balance sheet wise, I think we have a little bit too much debt gearing wise. If the debt load was about half, I think I would be a lot more interested. The thing is for me, if something goes wrong with the business and we suddenly stop making profits, that debt load still needs to be paid, interest still needs to be paid. So that's why I do worry a little bit on that front. Thankfully, there's a fair bit of free cash flow, which could potentially pay off the debt in a decent amount of time. But a lot of their free cash flow will be used to pay the dividend. So it's a double-edged sword. Do they decrease the dividend to pay down the debt? I personally think that would be a better move for the business. But yeah, who knows? I'm not the management of ITV, am I? So I think another, maybe not a red flag, but a concern for the investment thesis would be, where's the growth going to come from for ITV? It's a TV channel in the UK, most of its sales come from the UK. How is it going to grow that revenue? I know it's got the big shows such as Love Island and I'm a Celebrity, yada yada, Coronation Street, Emmerdale, whatever. But I don't know whether big growth's going to come from the business, and over time, I want the sales to be at least going up alongside inflation. So I don't know, I think with more advertisers wanting to advertise away from television as well, the they don't have the best, so they have headwind basically, so things are not going in their favour. Advertisers going online, digital, going away from television, it won't be a good time for the business, of course. But ultimately, the business is looking cheap on an earnings and free cash flow basis. And if you think the company's undervalued and the company has a good future, then it may be a decent addition. Hopefully this video gives you a bit of an insight into the numbers, of course. As always, I'm not a financial advisor. Please read my disclaimer. Don't just go and buy the stock based on my video. That would be stupid, so please don't do that. And yeah, so I'm just making videos on the internet to educate you all, and hopefully I'm doing that. If you enjoyed today's video, please subscribe to the channel. Thank you very much for watching. I will see you next time. Thank you for watching. As always, it would be amazing if you could like, comment and subscribe to the channel if you enjoyed this video. I will see you in the next one. However, you can check out some of these videos